Welcome back to the Ticks and Trades channel. My name is Sam and I trade the E-mini S&P 500 futures. This is a weekly recap of how our trades played out over the last 5 trading days from Monday, March 16, 2026 through Friday, March 20. Today is Sunday, March 22, as I am recording this video. I hope you are doing well. You are looking at a weekly chart of the SPY, which is the ETF, where we identify levels of support and resistance each morning before the opening bell. And then we use those levels in the SPY to trade against in the E-minis, which is the symbol ES. The week in question is this most recent candle here, where the bulls did not have a good week. They let price get below some key areas. The blue horizontal lines that you see on this chart are some of those areas. We talked about them in last week's recap. And now, as of this past Friday, March 20, we can see that price got below and closed below this lower level, which is SPY 652. That was an area that offered some support before on this weekly chart, and we wanted to see what would happen to price if they got down there this past week. The next level up was 659.03, and that was just a leftover gap that had not yet been filled as of last week on the daily chart. It was this gap here, the close of Friday, November 21, 2025. Not that these levels were necessarily official daily levels that we publish each morning for subscribers to trade against. These were just levels that we identified last Sunday evening in the last weekly recap video, just to see what would happen if or when price would come down and interact with them. Before we zoom in closer to learn a little about what price did at these levels, let's ask ourselves what it might mean now that price is below this 652 level. Well, here on the daily chart, we can see that each day for the past week, Monday the 16th is this first little green candle here after this vertical dashed line that marked the end of the previous week. So price went up into this zone that we've had on the board for over a month now, between 675 and 672. Hit the bottom of the zone on Monday, and on Tuesday they almost got price to the top of the zone. That's the next candle here. But the bulls just could not muster enough strength to get above, let alone close above, the top of this zone. They gave it up and price fell from there. Notice that on Thursday, price gapped lower at the open. They opened down here below this gap level here of 659.03 and below the 200 period moving average, the black line that's upsloping there. Let's go ahead and zoom in, say, on a 5-minute chart to show you what happened. So this is Thursday and Friday. This is when they interacted with these levels. Earlier in the week, they were not down there. So here's the gap lower at the open on Thursday morning. When you see price gap below or above important areas like this, it changes the odds of a reaction. In other words, let's say that in the middle of the regular trading session on Wednesday, that's all this action here, price came down into this gap level of 659.03 in the 200 period moving average. It's like a $1 spread there. If there was good volume and a lot of market participants, the chances were good that defense would be played by the bulls in this area between 660 and 659, say, and it would provide support, either a bounce on Wednesday and or follow through the next day or so. But they closed the day Wednesday above that whole $1 spread. I'm talking about the level between 660 and 659. We're just calling that a zone here. We just had this one level identified, but we knew these two levels were important ahead of time. The whole thing could be looked at as a zone. So they closed above that area and let the futures in the overnight session pull price down below that area. So they open below. That is generally the market showing some weakness. Sure enough, when price got back up to this 659, they had a fight to get above it a little bit. And when they finally did, what did they hit from the underside? The daily 200 period moving average. They spiked it a little bit, but the bearish momentum was just too much for the bulls, and by Friday, they were dripping even lower. They hung out a little bit around 652. And by the way, these levels did help inform some of our daily levels that we traded for base hits throughout the week, and we'll talk more about that later. So the only thing I can say about this recent price action is to not forget about the big picture. Over back on the weekly chart, price could be just testing this 50 period moving average. That's this blue line that's sloping up. The bull case could be that price spikes this 50 period average here on the weekly chart, and that's the reset that the bulls need. So we're talking somewhere around 644 or so. It's 643.95, at least as of Friday. And maybe the professionals start buying again and the rest is history. Maybe that happens, maybe not. Because if we zoom out farther, here's a monthly chart. Since we're still talking big picture here, and look at what price is doing over here, we see price possibly coming down to test the 20 period moving average. That is the orange line that's sloping up. Price has been mostly riding the 20-period moving average here on this monthly chart for a long time. We can zoom out. There have been dips below it for a few months at a time, of course. The argument could be made that since the beginning of 2012, which is where I'm pointing at right here, price has been solidly bullish and spending most of the time above the 20 period. And even when price did dip below, like during COVID and other times, all they were really doing was resetting back to the 50-period moving average, the blue line. During March of 2020, they actually found support at the 100-period moving average. That's this purple line, or whatever color it looks like on your screen. It looks purple to me. But most of the time, the pullbacks were pretty normal and typical. Once again, it's good to not lose sight of the possibility that at some point, price might need to get all the way down and possibly get below some of these monthly moving averages before the next long-term leg in the market happens. They're just extended. That's all. This big picture stuff really doesn't do a lot in informing our intraday scalp trades with the E-mini futures. For that, we use levels that are good just during that day. Each day is different. In all the years that I've been messing around with the market, I've found that the best way for me to pull the highest returns is to not tie up all my capital waiting for big, slow moves, like being long all the time or even trying to short the market for a period of time, like a few months, like buying long-term put options. They might work, but meanwhile, all I've done is tie up capital that I could have been using to get into futures trades during the day, where I'm always back in cash by the end of the day. Let your IRAs and your 401ks make you some average long-term returns. If you want impressive returns with just a little bit of effort on your part, trade the futures intraday. It just works. Since we're talking about the performance of trading the futures, we'll look at the past week's worth of trades using our strategy in just a moment. I want to close this out by going back to the daily chart, just to say that until we see signals on the daily and the weekly charts that this pullback is over, it's not over. Price has gotten below some important areas with little to no defense by the bulls. We'll probably get some back and forth in the meantime, but I suspect there could be a longer-term target somewhere lower than where they are now. Maybe we can look at two other indexes first. The transports, the DJT, have been trying to bounce from 17,700. That's this lower blue line here. We talked about that level last week as a place that the bulls needed to defend. They still might. They've been messing around with it, but they seem to be putting in some signals that look more bearish than bullish. On a 10-minute chart, you can see what they're doing. This is last Friday when we first talked about it. Now they've been bouncing off of it several times. It continues to be important, this level at 17,700. If the bulls can defend it and get price to rally from here, that could help the bull case in the SPY as well. And then here is the Russell 2000, the IWM. They're in a different place than the SPY, the spiders. The close on Friday, the 20th, is right here at an area that could be important, or an important place that the bulls might defend this upcoming week. This is the level at 242.50. So keep an eye on that level over here in the IWM this week. If we see some daily closes above this level, and the transports are fighting their own pivotal level, the one we talked about at 17,700, then these markets could lead the SPY. Just a couple things to keep an eye on. Now the tracking log. This is currently filtered to show just this past week, March 16 through the 20th. We had a couple days where individual trades sucked some points and dollars away, but just one day where we ended behind the curve. And that was on Friday. The rate of return for the week was a little over 4% if each of the levels posted for the day were traded correctly. And again, if you want to read and see in detail how the levels from the morning fared, then just head over to the Ticks&Trades website and go to this daily recaps blog, where you can see the whole picture after the closing bell of each of these trading days. Just pick one and dive in and see what you can learn. This is an example of Thursday this past week. Before the market opened, after the market closed, what happened, and the tracking log for that day. But anyway, back to the tracking log. Now we have the year to date. This is 2026, to date through Friday, March the 20th. We're a little above 46% rate of return for the year, and you can check out the other metrics that we track. Hopefully it's all mostly self-explanatory. In the last video, I mentioned that I wanted to do something kind of interesting, at least I think so. I asked the question, I wonder if we can forecast when we might hit 100% rate of return for the year. In other words, at what point in time is it likely that our money would be doubled? In case you're wondering how that is tracked, it's based on a $50,000 starting balance at the beginning of the year, or any point in time that we're looking at this log, and every level is traded the same, and we follow every single rule correctly. And the position size for every level is 2 ES contracts. That is why this column here is highlighted. So for where we are in time now, that $50,000 would be worth $73,000. Every one of these trades going back years has been cataloged and tracked, and it's all available either on this YouTube channel, back when I did a daily recap video, or more recently on that blog page on the website that we just looked at. So based on this previous year's performance, at what point in 2026 will this $50,000 be worth $100,000? Well, here's some data that might help. Each year, starting with 2022, this is what I pulled. First, where were we as of March 20 for each of the years? This is the point in time where we are now, 46%. So you can see in 2022, we were at 23.8%. In 23, it was 29.45%, and so on. And the next piece of data was at what point in the year for the past 4 years did we actually hit 100% return? And these are the dates shown in this column. So the question is, where will it be this year? Now, I already have an idea of what day, or maybe better like a date range, say within a 2-week range or so, where we might hit 100% for 2026. I'm going to leave it blank for now, and we'll revisit that for the next weekly recap. If you want to take a shot and figure out your own projection, feel free to tell me what you think and just use the comment section below, like just a date or small window of time, like a 2-week range of when you might think it could happen, when we might get a 100% rate of return for 2026. Of course, this is purely for entertainment. The market is going to do what it's going to do. We might have a run of bad days or even weeks, but if the last few years are any indication of future results, then we can probably make an educated guess about where we'll get into the double digits. I'm pretty confident that we will, not just because this strategy has consistently performed in the double digits for annual returns. It's mostly because when you focus on the intraday market and price action, you can generally spot short-term trends and places where trends might change and identify levels where the bulls and bears are likely to battle it out, and our trading approach takes advantage of those times, just to pull a few points out of the market at a time. We're taking bites out of the apple. We aren't trying to nail the top or nail the bottom of big market moves. These base hits pile up, as we keep saying. Anyway, I'm curious to know when you think that the Ticks&Trades futures trading strategy will hit 100% rate of return for this year. Comment below. I appreciate it. So that's a wrap for this recap. We'll close here back on the year-to-date tracking log. I hope you found some useful and actionable information in it. Consider subscribing to the channel. That will help this thing grow. As you can see, this channel currently has a small band of followers. You know who you are, and I appreciate that you continue to support the channel. Thank you, trade well this upcoming week, and stay disciplined, and I will talk to you again soon.